Hey guys, what's up? How's it going? Welcome back once again for another video on the channel. In today's video, I'm going to be sharing with you guys 3 undervalued Canadian stocks to buy. Hey guys, my name is Robin, and if you guys are brand new to the channel, this is a Canadian-based investing channel that I created on YouTube earlier this year. And throughout this year, I've been showcasing with you guys everything I've been learning when it comes to investing, dividend investing, and I've shared with you guys how I built a dividend investing portfolio completely from scratch. So the markets have been pretty interesting lately, with them actually getting a bit of a rally over the past couple weeks, but I still think there's a lot of undervalued stocks, specifically Canadian stocks out there to buy right now. So in this video, I'm going to share with you guys 3 Canadian stocks that I think are some pretty good buys right now, and you guys are really going to enjoy this video. And I'm also going to mention that before we get into the video, that all 3 of these stocks I actually own, and throughout this video, I'm going to show you guys how many shares I have of these stocks, and I'm also going to show you guys what my earnings are and what these stocks are sitting at currently inside my portfolio as we go through them. So like usual, if you guys enjoyed the video, please be sure to give it a big thumbs up, and remember to subscribe if you guys want more Canadian-based investing content. So let's get into the video, and let's see what my first stock to buy for this week is. So the first stock on this list is none other than a good old-fashioned Canadian REIT called RioCan. So before we jump in and talk about RioCan, I just want to say really quickly, guys, that about a couple weeks ago, I did do a dedicated video talking about RioCan, so check that video out if you guys want. It's not, I wouldn't say it's outdated, but a lot of things have happened over the past week, but you guys can still check that video because I do dive a lot into RioCan. And in today's video, I'm just going to kind of summarize and share with you guys some things that I like about RioCan and why I think it's really actually an undervalued stock to buy right now. Since the pandemic, REITs have taken a pretty hard hit, with offices and retail being shut down for the greater part of Q2, and as you guys can see from this graph right here, RioCan took a massive hit as well. Before the pandemic, RioCan was trading at about $27 Canadian, and it's currently trading at $17 Canadian, so as you guys can see, that's a big drop, and it recovered a little bit, but it still has tons of room for recovery going into the future. Now the good news at the end of the day about this is that Canadian REITs, including RioCan, have actually shown good signs of recovery from the third quarter. So going into the fourth quarter, I think that recovery is going to continue. Now there might be threats of a lockdown, but I still think most REITs are actually doing quite well. And I think what we've seen in Q3 actually is going to be continued more going through quarter number 4. And whether or not we get a lockdown, I still think RioCan is a very, very muchly so undervalued Canadian REIT that is 100% worth buying right now. And the good news at the end of the day is that REITs, including RioCan, have showed signs of recovery following a much better Q3 than a Q2. As you guys can see here, Q2 was pretty horrible for the REITs, specifically RioCan here. And as you guys can see, they lost $350 million, and this is from everything being shut down. But once the economy kind of opened back up and things went back to recovery, you can see that RioCan got a lot of their earnings back. So I think as long as another lockdown doesn't come, I think that's pretty much going to be the big thing for RioCan. And as the economy recovers, we've seen RioCan share price also go up as well. So I think going into the future, at some point in time, RioCan will recover. It's just a question of when. And if we talk about one of the biggest pros of buying RioCan right now, one of the biggest pros we can see here is the fact that RioCan is still down negative 35% over the past year. This is just absolutely crazy. And as you guys can see, this presents a massive opportunity to buy one of Canada's largest and most profitable REITs. And I think being down negative 35%, even just getting this little bit of recovery already, has been actually big gains for anybody who's invested in March. So I think this probably represents the biggest factor, and really just shows us how undervalued RioCan currently is right now. And this presents a massive opportunity to buy one of Canada's most largest and also one of Canada's most profitable REITs at a huge discount price. And I think over the next couple months to the next couple of years, Canadian REITs will gain a lot of their value back, and I think REITs such as RioCan are going to get huge profits and huge stock appreciation go over the next couple years. And of course, one of the biggest benefits of investing in RioCan right now is the fact that they have a dividend yield of 8.33%. And if you guys buy the stock right now, you'll lock in that dividend yield for years to come. And this is another huge reason. So with that huge, big potential to get that stock appreciation, you also get a nice solid dividend yield that can grow into the future. So of course, this 8.33% dividend yield is also looking really good right now as well. So if we combine the potential for future stock growth and stock appreciation with a very nice high dividend yield that's going to be compounding and always growing into the future, I think RioCan looks pretty good right now. Now there are some concerns about RioCan keeping their dividend active, but honestly, I believe RioCan being one of the biggest REITs they are and having an excellent balance sheet and having a market cap of around $5.49 billion, I think this company can take the blow. And as you guys can see, it is one of the biggest REITs that Canada has. So I think at the end of the day, they're going to do fine, even if another lockdown does happen. And in Q3, RioCan had a great recovery, and rent collection was at a 93.4%. So as you guys can see, they're doing perfectly fine, getting that rent in on a regular basis and keeping that cash flows and that profit and that revenue coming in. In quarter 3, RioCan managed to make a combined revenue of $309 million and make a total earnings of $117 million. And when it comes specifically to Canadian REITs, I think RioCan is one of the safest and the most undervalued REITs to buy right now. RioCan is currently trading at $17.29 Canadian on the TSX, and it trades underneath the ticker REI.UN and currently has a dividend yield of 8.33% at the time of doing this video. In my own personal account at Wealthsimple Trade, I own 48 shares of RioCan, which makes a total value of $830 Canadian, and my all-time performance of RioCan to date is up 12.78%. Alright, so the next stock recommendation on this list is going to be none other than a solid financial stock called Manulife. So as you guys can see in this video, my main focus in this video is to target companies that are solid companies that have a long history of growth, a long history of earnings, and a long history of stock appreciation, but also have some companies that have good dividend yields as well. So I'm particularly looking at stocks that fit these descriptions, as well as stocks that actually are trading at a little bit of a lower value than they did earlier this year, so that over time, once the economy recovers, these stocks are almost guaranteed to get that value back and can continue growing. So you can get them for a nice cheap price right now and get all those things that I just mentioned. And as you guys can see, Manulife is currently down about 17% over last year, which makes it a great dividend stock with tons of room for stock appreciation over the next few years. And just as you'd expect, just like in RioCan's case, Manulife has a solid dividend yield of about 5.21% doing this video, which once again makes this stock a really highly undervalued stock with a nice good dividend yield that's really perfect to buy right now. Adding a dividend yield of 5% to your portfolio, along with the potential to grow and have some nice stock appreciation going in the future, I think is a great reason why you should add Manulife inside your portfolio. Manulife is a very large Canadian company with a market cap of about $41 billion, so they are very well diversified and have revenue streams from Asia, Canada, and the United States. And just like most other businesses, quarter 3 was a successful Manulife, and this proves that if they keep this up, their stock price should definitely start to increase over the next little while. And the cool thing about Manulife is with everything going on with the pandemic and a bunch of Canadian companies suffering and having a hard time, Manulife just keeps growing and they're actually coming out ahead. So this is why I really think Manulife is a good company and a very undervalued Canadian company to invest in right now. And I think going into the future, they're going to be one of the more safer Canadian companies to buy, and their stock is trading at a really nice price. So I think now is a good time to lock in that nice cheap price before share prices rise going into the future. Manulife currently trades on the TSX for $21.50 Canadian and is traded under the symbol MFC, and they currently have a dividend yield of about 5.21%. Manulife currently has an annual dividend of about $1.09 Canadian, and they have an absolutely amazing payout ratio right now, sitting at about 35%. So this looks absolutely great, and this basically tells us that over the next couple of years, Manulife has tons of money to grow the company and grow their dividends, which is why I think this stock is such a good company to buy right now. Inside my tax-free savings account on Wealthsimple Trade, I currently own about 19 shares of Manulife, which is a total value of about $408 Canadian, and my all-time performance is up 9.77% with Manulife. Alright, so last stock on the list is going to be none other than a Canadian bank, because I still think Canadian banks are some of the most undervalued stocks right now. Now, traditionally, my favorite bank to invest into all time is TD, but I'm actually not going to talk about TD in this video because my main reason is I want to focus on a bank that actually has good earnings, good growth, but also a bank that probably has been hit the most so that we can get that nice stock appreciation going into the future. And that stock is none other than Bank of Nova Scotia. And since Bank of Nova Scotia probably got hit the most by the pandemic, and their share price is trading at is recovered basically the least since March, I do believe that this is probably one of the most undervalued companies because they are a solid bank. They do have good earnings, and although the recovery has been a little bit slower than the other banks, I still think going into the future at some point in time they will get that share price back and they will continue to grow. So I think this is one of the reasons why this is one of the most undervalued Canadian banks to buy going into the future. And just like the other stocks on this list, Bank of Nova Scotia also is trading at negative 16% what it was earlier this year. So just like the other stocks I mentioned before, this stock is still lagging a little bit in recovery, but I think this really presents a good opportunity to buy this stock at a cheap price before it recovers. And of course, Bank of Nova Scotia also has a solid dividend, trading at 5.67% of a dividend yield. This is actually really, really good, especially for Canadian Bank. And Canadian Bank's a pretty solid dividend yield, so I think locking in this 5.7, almost 6% dividend yield right now with growth going into the future is absolutely solid. Now, even though Bank of Nova Scotia is continuing to climb up a little bit like some of the other stocks I mentioned here, but at the end of the day, I still think there's tons of room for growth. And even though, they're growing a little bit and we benefited from that, I think if you're going to buy Bank of Nova Scotia today, I still think there's tons of room for growth, and I still think it's a really good undervalued stock. Now, although Bank of Nova Scotia did have a positive Q3, as you guys can see here on the graph, their revenue and earnings are still down quite a bit, and this is mostly because of the reason that they have a lot of business international in like the Asian markets and stuff like that, and they obviously got hit pretty hard. So we could probably expect that to lag behind a little bit, but as you guys can see, they did get a little bit of increase in Q3. I think going forward, once that their international earnings really start to stabilize, we will start to see that revenue grow once again. And at the end of the day, I see this as an opportunity to buy one of the best, most undervalued Canadian banks at some rock solid cheap prices. One also nice thing about Bank of Nova Scotia is they currently have a price to ratio of 11.31, which also suggests that the stock is undervalued and trading at a low price right now. The nice thing about Bank of Nova Scotia is they have a really solid balance sheet, and even though their earnings have been hit pretty hard and they've kind of lagged behind some of the other banks, they have tons of cash flow, and at the end of the day, all the big Canadian banks are safe because they have so much money on hand and they can easily deal with another lockdown or if we have some kind of shutdown going on into the future. Bank of Nova Scotia is currently trading at $63 Canadian on the TSX under the ticker BNS, and currently once again has a dividend yield sitting around 5.6% at the time of doing this video. Now, I don't hold any individual shares of Bank of Nova Scotia because I recently sold them to kind of clean up my portfolio a bit, but I do have a lot of Bank of Nova Scotia in an ETF called VDY. As you guys can see, Bank of Nova Scotia represents 7.5% of this ETF every time you buy a share. So if I go inside my Wealth Simple Trade account, I have 71 shares of VDY with a total value of $2,283, and I'm currently at 5.86% on VDY, which represents the overall Canadian dividend-based market. Alright, so that's it for this video, guys. Hope you guys enjoyed it. I hope you guys enjoyed my top 3 undervalued Canadian stocks. If you guys want, go in the comment section and share with me your top 3 undervalued Canadian stocks. We'd all like to hear them. And before we finish up this video, I just want to mention about a week ago I did a video called the top 3 Canadian banks to buy right now video. Check that video out. I'm going to put an end screen that you guys can click if you guys want to check out that video. It goes over the top 3 Canadian banks that I think are worth buying right now. So you guys can check that out if you haven't. But other than that, guys, thanks for watching today's video. Hope you guys enjoyed it. Let me know what you guys think in the comments. Be sure to give the video a big thumbs up and subscribe to the channel if you guys want more Canadian based content. Thanks for joining me today, guys, and I'll see you guys later.